to start a meteorologist program.
Right, we seem to be live streaming early. I'm not quite sure why we'd be live streaming before we are starting the webinar. Can we start the webinar and let people on the invite? Sam? Hi, everyone, and welcome along. Welcome along to the Sunday market updates from Access to Wealth. My name is Paul Bottrell, and I am your host today. Joining me in the show today, our trader from Brighton Beach or Hove in London, Ash Bill. In the UK, we've got Lloyd coming in from Singapore, and I believe we'll have Alexis coming in as well from Singapore. We're going, I think, to go. Lexi's in?
Yeah, she probably needs to be given powers. She's in the other side of it.
Fantastic. Let's get Lexi some powers and get her over to here, and then we'll get straight on to her and get into fundamentals. Once Alexis is in, we will do fundamentals. Then we will do currency strength with index with Lloyd, and then we will do. Are we doing data today with you, Ash, or are we doing FTSE?
I think we do FTSE today.
Fantastic, man. I'm looking forward to hearing about that. Stock markets are really where it's at for me right now. Lexi, welcome. How are you?
Hello. Hi, I'm doing good.
Good, welcome along. Look, I'm going to restart the intro because you're a bit late in, or we've just been juggling through, so we'll start from now. Right here, we're going to open up the show with Alexis doing fundamentals live. Again, key drivers for the markets right now. There's a lot of big things happening that are moving markets. What lies ahead for us this week, Alexi? What should we keep an eye on as we go through the week?
All right, thank you, Paul. I'm just going to quickly share screen, and we're going to take a look at some. I've got something a little bit different this week to look at. Now, what I have here on my screen, just make sure I'm sharing the right one. All right, over here, I'm actually on a website called worldgovernmentsbonds.com. Now, this is interesting because I think the next period of the next period, when we are in times of uncertainty, what we do want to look at is world government bonds, right? So we want to see, so basically for those of you who are very new to bonds, the reasons why people or hedge funds, they put their money in bonds is mainly a flight to safety, right? Because if, for example, we are in a bear market, if the stock market isn't doing well and you need to hold on to your cash, sit on it and wait, for a better time to enter the stock market, where do you put your bonds? If you put it in a bank account, the interest is really miserable, right? But what the other option is to park your money in some form of bonds, because at least from bonds you have a ready stream of income, you can get a stream of interest payments, and it's also a very common way to diversify your portfolio as a form of safety, right? But when I talk about bonds, I'm mainly talking about government bonds, because if we are looking at corporate bonds, then of course, if companies can fail, so there is a risk in corporate bonds, and the risk in government bonds are then a lot lower, because if companies can fail, countries can't quite fail in that sense. The government has to intervene and not allow the country to fail. So I think the next play on currency or money flows will be in where do we park our idling funds, right? So there's two things that we are looking at for in the bond markets. One is the yield, and the second part, of course, is how much do they need to buy in. So it's a combination of price and yield. And with the interest rate market heating up, right? A lot of the countries have already raised their interest rates. Interest rates are already going up. I think the next question is, while waiting for the stock market to recover, it might take weeks, it might take months, it might take years. We're not too sure on how that goes, right? Because inflation is so high now. In the meantime, for hedge fund managers, for pension fund managers, where do they park the funds for investors in an attempt to stabilize their portfolios, in an attempt to preserve their yearly returns, then bond is actually the market that is getting a bit of interest right now. Now, what is interesting about bonds is this. There's an article from the Financial Times, right, that investors have pulled 50 billion from emerging bond funds in 2020. Now, of course, in bonds, there's also an element of speculation and risk. So why do people buy emerging market bond funds? Is because emerging market bond funds, they pay very high interest. So if we look at the bond funds, emerging markets will be like the smaller countries. For example, we have Vietnam 3%, we have Indonesia at 7%, we have Bangladesh 8%. You go all the way down the road, we have if you apparently buy a Zambian government bond fund, it's 27%. Of course, the rating isn't that great, so that's not the best way to go. But even the Class B funds, right? The Class B funds, you have Russia at 9%, Mexico 9%, Nigeria 11%, right? So these are a combination of emerging markets as well as newly developed countries or developing countries bonds, all right? So the attraction is there because by parking your money in these, I would say, subpar bond funds, you're right, what you are taking on a bit of risk, but what is the other aspect about it is that you get regular interest payments in that sense. So it is risky in the terms of the bond portfolio, but at least it kind of guarantees a certain amount of interest rate payments in that sense, right? So what's happening right now is we have the flight to safety, which means investors are moving away from risk. So all these funds that are emerging markets no longer become interesting because they are now deemed a little bit more, what I would say, risky, right? So what has happened is emerging markets, they are actually having a fund outflow, right? So because investors are pulling out from the bond market in emerging markets. So instead of high interest, riskier bonds, they are pulling out from these emerging market bond funds to pour it into what we call a safer bond fund. All right, what are the safer bond funds? Of course, will be the bigger developed countries, the more stable economies, right? So this is why there is an interest that I am interested in looking at the bonds. To be a bit more specific, I've cut them out a little bit here. So we have, for example, if you're talking about, okay, should we park your money in the Japanese yen? The Japanese yen, politically stable, or the Swiss also deemed politically stable, but the yields is so low, right? So the interest might not be as interesting to park your bond funds with a very low yield currency. But how about the UK at 2.25? The US is 3%, right? The US bonds are now very interesting right now because they have a higher yield as compared to their fellow developed countries, right? We have Australia 3.5, we have New Zealand 3.6, not too bad as well. UK 2.2. So I think the next couple of weeks, it will be interesting to see the market flows of these yields. So if I'm looking to trade, right, I am going to veer a little bit more towards the economies with a stabler bond market, because in the flight to safety, I think the money flows will be towards the bond side, especially if a lot of these economies are also tightening their monetary policy, which means they're no longer printing money, they are increasing interest rates. The money supply is a bit more controlled. All right, so I'm looking to a couple of these currencies. So if we want to narrow down now, I have always been a fan of the Australia and New Zealand economy in that sense. It hasn't been doing so well the last couple of weeks, but that might just be a retracement issue. So if we just take a quick look at some of the Australian and New Zealand currencies, probably might have to give it a bit of time for it to retrace or go down a little bit more, but we are reaching a couple of interesting levels, especially when we pair it with the weaker economies. It is actually interesting to see where it might go. So I have actually a combined index view over here. Let me just go to the FX list. All right, so the currencies, and now, for example, currencies mainly like the Aussie dollar, I won't really look at that because both of these currencies, I'm a bit bullish on the Aussie, I'm a bit bullish on the dollar as well. What I'm actually looking at are the currencies paired with a slightly weaker currency, for example, the Aussie yen. Now, I know the Japanese, the Japanese currently is going through a little bit of a social political upheaval at the moment, but policies won't change overnight. So I don't think the yen will strengthen straight away overnight. I think the baseline for the preference of a weaker Japanese yen is still there. So I'm not going to, I'm not going to buy the yen straight away just based on what happened over the weekend. Really sorry about that. But we are looking at possibilities of yen retracing and then opportunities to get back still in the direction of a weaker yen, all right? Because the policies for a weaker yen are still in place. It's not going to be changing overnight. So what I'm looking at is for currency pairs, like for example, the pound Aussie. All right, I think the Aussie in the longer term, in the mid to longer term, will outperform will outperform the pound. It's been in a range so far, but again, a lot of things has been happening on the UK side as well. So I expect a little bit more range bound for the pound while they try to figure out and sort out their political situation. But from a currency perspective, there is a potential for the pound to weaken against the Aussie. Maybe not too far because the baseline is already pretty low, but at least there's a little bit of space here that we are looking at. We are looking for it to fill in the next couple of weeks. All right. Pound Kiwi again, it has been sidelined for quite a number of while, but I am preferring my preference is to trade the Pound Kiwi towards the short side. All right, because fundamentally, the pound still has very high inflation. The bond yields are not as attractive as compared to the Aussie, the Kiwi, as well as the US. So these are the three currencies that I will focus on. But again, I will not trade Aussie, Kiwi, and dollars together because the three currently has a bit more attractive. They're a bit more attractive in terms of money flows towards the bond market. But what I would try to look at is for their strength against the other weaker currency pairs. All right, and that's all for me, Paul. Over to you. You're muted.
I'm mute. I don't want to put you on the spot too much, Alexis, but what happened with Sri Lanka? Government's going broke, defaulting on debt. Do their bonds get defaulted as well?
Well, I would say yes and no. I mean, if they do default, it's going to be very bad. But I think very similar to the Greek and the Spain bailout, we will have to see whether or not the global bank steps in to give them a hand. But definitely those bonds have really crappy ratings, and if it does default, it will be quite a big. Let me see. I think I got it on here. Okay, again, I wouldn't say it's impossible for a country to default on its bonds, all right? But, the probability of not getting help, and Sri Lanka, I think in terms of its global impact is not as big, right? So if Sri Lanka defaults, it's not as big as compared to, for example, a Spain or, for example, to a Mexico, things like that. So they might or might not get help from the respective banks. They might print more money, so I will have to see what's the monetary policy over there in terms of their stand. But I would say that if you're looking at Sri Lanka at 22%, they don't have a very fantastic rating at this point, so it will be already a risk in terms. It's got an SD rating. I mean, to buy a Sri Lankan bond, it really is a risk on its own already.
ST, what's ST? Does that mean suspended?
Yeah, it's not suspended. Oh wait, let me just.
Invest in Scotch whiskey.
Yeah, that's the more.
That's give you a YouTube warning.
Yeah, it's the riskiest side. It's so risky that the website didn't allow me to click it. But yeah, yeah. So I think anything below a CCC, it's like super risky. I don't think we would even want to consider these. But these are just like for reference in terms of the comparison. If you are buying bonds, we are looking for A. Minimally B, but the triple A's are the A's are best, the B's are already subpar. So to go anything beyond the B, I wouldn't even touch a C bond, in that sense.
Cheers, Lexi. Thanks very much for the explanation. Much appreciated as always. So bonds are something to watch. We're a little bit bullish on the Aussie, the Kiwi, and the US dollar. Boy, interesting to see how high that thing can go. Had another flying week last week, didn't it?
Yeah, definitely.
Rightio, let's hear about talking about